Welcome back, financial friends, to Am I Catching a Falling Knife? The podcast where we cut through the market noise to find out if a recent stock dip is a true danger or a golden opportunity. I'm your host, Dave, and today we're sharpening our focus on Cardinal Health, ticker CAH. This stock has taken a noticeable tumble lately, dropping over 7% in just the last few days. Is CAH a classic falling knife we should avoid? Or is there a compelling story underneath that makes it worth a closer look? Let's find out. So, what's driving this negativity? The single most dominant factor sending CAH downwards is the market's reaction to their recent Q4 fiscal 2025 earnings. Specifically, it wasn't the EPS beat or even their raised guidance for fiscal year 2026, which, on its own, would typically be good news, signaling about a 3% positive bump to future earnings. The real concerns emerged from a Q4 revenue miss and, perhaps even more significantly, the announced $1.9 billion acquisition of Solaris Health. Investors are clearly a bit nervous about how this acquisition will be financed and what it means for the company's top-line performance moving forward. Let's get a clearer picture of who Cardinal Health is. This is a massive multinational healthcare services and products company. They're primarily known for distributing pharmaceuticals and medical products, serving over 100,000 locations globally, from hospitals to pharmacies. They also manufacture a range of medical and surgical products and run one of the largest radiopharmacy networks in the U.S. When you look at their revenue, it's heavily weighted towards pharmaceutical and specialty solutions, making up over 92% of their 2024 revenue. Geographically, they're almost entirely focused on the United States. Financially, they're a giant with over $222 billion in annual revenue, $2.5 billion in free cash flow, but they do carry about $8.5 billion in total debt. One really crucial number to note here is their gross margin, which is quite low at just 3.53%. Now let's break down how all these pieces are impacting their earnings and why the market reacted so negatively despite some positive news. We estimate a net negative impact of about 6.5% on their upcoming quarterly earnings. So, how did we get there? Let's walk through it. While the raised FY26 guidance is good, promising roughly a 3% positive boost, it's getting overshadowed. The Q4 revenue miss signals potential weakness in that huge pharmaceutical and specialty solutions segment. Because Cardinal Health operates on such thin gross margins, remember that 3.53%? Even a slight miss on revenue can have a disproportionately large negative impact on their net income. We're looking at about a 3.5% negative pressure from that revenue miss alone, effectively wiping out more than half of the positive guidance. But the biggest piece of the puzzle is the $1.9 billion Solaris Health acquisition. If this is primarily debt-financed, new interest expenses alone could be around $28.5 million per quarter. Compared to their estimated quarterly net income, that's roughly a 4.5% negative hit. Add in the initial integration costs, and the acquisition's combined immediate impact on earnings is estimated at around a negative 6%. So, when you combine the initial positive uplift from the raised guidance, the negative hit from the revenue miss, and the significant costs and financing concerns of the Solaris acquisition, you end up with that net estimated negative impact on upcoming quarterly earnings. So, with that in mind, what's this stock really worth? To figure this out, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm assuming a growth rate of 13.1% based on their EPS growth next 5 years estimate, a discount rate of 9.5%, and a terminal growth rate of 2.5%. With these assumptions, a base case DCF value, before considering the recent negative narrative, comes out to about $146.37. But when we apply the potential impact of this market narrative, that value drops to around $133.93. The second method is a bit simpler, a PEG-based valuation, which gives us a fair value of about $126.55. The current price is $146.30, which tells us the market might still be pricing in some of that older, more optimistic outlook, not fully accounting for the recent news. So, where might be good spots to consider stepping in if you're interested in CAH? Based on these analyses and keeping that potential future earnings impact in mind, I've got some custom buy levels for you. The first level I'd be looking at is around $125. If it keeps dipping, I'd consider $115, and for a deeper value play, possibly even $100. These levels give you a bit more margin of safety considering the immediate headwinds. So, to wrap up our deep dive into Cardinal Health, CAH. Now, a quick but very important disclaimer. Everything we've discussed today on Am I Catching a Falling Knife is for informational and entertainment purposes only. This is not financial advice. Investing involves risk, and you should always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. That's all for today's episode. Thank you for tuning in. Until next time, stay smart, stay safe, and keep those portfolios growing.